Careful. Go over. Yo. What is up? What is going on, everybody? This is our weekly Friday live stream. Thanks so much for tuning in. Today's video was actually a really cool video. We got a lot of questions about it. So we wanted to make a video and drop basically, is it better to get a HELOC or is it better to refinance? And we get this question all the time. A lot of people reach out to us specifically because they want to tap into the equity that they have. And people don't really understand the difference between a refinance and a HELOC and how it can affect you when you're looking to scale your portfolio. So we wanted to create a video just on that and how it works. So if you guys want to check out in detail what that looks like, just go on our YouTube channel and check it out. And yeah, so we're just going to dive in basically the Cole's notes as to what our video was and how it's going to affect you guys. So if you guys have any questions during the live chat, feel free to ask me questions either on YouTube, Facebook, or Instagram.
Yeah, guys. Equity. Obviously, it's a pretty key factor being able to move forward with both the BRRRR strategy and just those for maybe beginning with their investments and maybe have a primary residence that's been accumulating some equity and you're not quite sure how to utilize it. You've heard maybe two possibilities. You're considering, the HELOC route, or maybe you're considering a refinance. Both good options, but both have their own specific place and utility. Looking at, starting with the HELOC, and how it's different than refinance. HELOCs, it's a revolving line of credit secured on the equity in your home. So, you have to be able to have that equity in your home for it to be able to be put on there. In terms of loan to value, it's going to be structured a little bit different than a typical refinance. Regardless of whether the property is a rental or your primary residence, your HELOCs are limited at 65% loan to value. Because it is free access and there is no consistent requirements, they do limit you to that 65%, just to help securitize everything. Take a look at the refinance. Refinances, you're going to be getting somewhere between 80 to 75% on your maximum loan to value. There's a few things that kind of determine whether or not we are getting 75 or 80. First one would be the type of lender that you're using. A lenders allow you to go to 80% on both the rental and primary residence. Now, there can be some things that can, change and scale back. If the property is in a very rural area, even on the A side, they may just limit you to 75% just due to risk management. But typically on the starting rates, you're looking at 80% on both the rentals and primary residences.
Somebody actually just asked a question. He asked, what are we seeing currently in the market for home equity lines of credit? Currently on the A side, we're looking at prime plus 0.5 at the moment. It really just depends on the bank and the type of product you're getting. There are a handful of different products available to you. So there's something called a standalone line of credit. And then there's lines of credit that are created through mortgage products. The broker channel, for anyone who doesn't know, the broker channel doesn't have access to standalone lines of credit, like how the bank would give you a line of credit. We can't just add a line of credit on top of your mortgage that you already have with a bank, unfortunately. But we can offer you products that do have lines of credit built into them, such as the Scotia STEP program, or MCAP has something called the Fusion product. These products, how they work is basically they'll give you a loan up to 80% loan to value of the property. And then once you have that loan, your home equity line of credit starts at $1. And as you pay down your mortgage, every single mortgage payment that you make, the principal of that payment goes towards opening up your line of credit. So eventually, as you pay down your mortgage, the line of credit opens up. And obviously, you guys don't pay for the line of credit that you don't use. So it's just one of those really cool features that if you can qualify for it with your income, I would highly recommend using it. It's just good to have, and it grows as you pay down the mortgage.
Well, another thing that we actually have access to, which is can be useful for some of you who have maybe either been laid off or have lost your jobs and are looking to invest just as of COVID. We do have access to a private line of credit as well, too, with one of our residential mortgage investment companies. they are able to put a 1-year term HELOC on your property. So that is something that we do have access to as well. Does come with a little bit higher carrying cost, but if you're maybe just waiting on a few months or 6 months to be able to get back into traditional lending qualifications on the HELOC, and you really need access to some of the equity in your property, that private HELOC might be a good option as well too. Maybe if you're looking to do some flips and stuff and you just want to access some quick capital, that can be a great product to have as well.
Yeah, some of our private lenders, they'll also do like a makeshift home equity line of credit. They'll cross collateralize one of your assets that has some equity in it, and they'll do like a draw, like the Calvert Mortgage Mortgage Investment Corporation that we're doing the $20,000 flip with. They will allow you to use one of your assets and then draw against it and then pay it back and draw against it, kind of like a line of credit. Some of our other lenders will allow you to also cross-collateralize other assets and hypothetically use it as a line of credit as well. Getting back to it, is using a line of credit better than a refinance? And basically the differences between them. A line of credit is seen differently in the eyes of a bank. So the way a line of credit is going to work is it really depends on the bank, first of all. So some banks will look at your line of credit as 1.5% of the outstanding balance of that line of credit. So if you have a $100,000 line of credit, 1.5% of that is going to be used as your monthly payment. Some lenders look at it as an amortized payment. So they'll take your line of credit balance and then they'll amortize it out over 25 years at prime rate, and they'll use that. Now for unsecured lines of credit, we use 3% of the outstanding balance as your monthly mortgage payment, or your monthly payment on the liability. Home equity lines of credit can be good for a handful of reasons, though. They can be good for people who are looking to do a flip and who need access to large amounts of capital but don't have the ability to be able to sit on liquid funds. They're good for people who are doing flips, who are doing some renovations. This specific product is really good to get into when you're initially starting your investment journey, specifically because the more properties you have on your personal debt servicing, the more difficult it's going to be for you to qualify for that product over time. Eventually, if you have or amass a portfolio of real estate and you've maxed out your personal debt servicing, qualifying for a home equity line of credit actually takes a higher qualification rate to qualify. So what we do is we qualify at 2% above contract rate, but the contract rate that lenders make us qualify at is going to be the home equity line of credit rate plus 2%. So, if you're doing prime plus 0.5, you're looking at 3, you're qualifying at above 5%, which is a little bit higher than what your normal qualification would look like. So I would recommend, if you're going to look at a home equity line of credit as a tool in your tool belt for investing, I would highly recommend using or getting that at the start of your investment journey.
Mm-hmm. One of the things we want to talk about too, just moving down kind of the scale of use is exactly that. Like, when can you use each and which product is going to be best for which scenarios? If you're simply just looking to have access to equity and maybe you don't feel like paying for it right off the gate, and you want to kind of pay per use, specifically more for like the renovations or contributing factors to some smaller down payments, a HELOC can be good. You're not paying a immediate principal and interest payment on it like you would on a refinance. You're paying per use, and it is an interest only payment. On the refinance side, you do instantly start to have an increased principal and interest payment as soon as the mortgage closes, because you are refinancing the actual property and the mortgage payment itself. But in terms of use, specifically more for down payment or larger fees, maybe car payments or something like that, if you're looking to buy something cash, the refinance is going to give you access to larger amounts of use. Specifically on real estate down payments, refinance allows you to use all of the funds entirely for the down payment. There is no limit. HELOCs, we're starting to see some of the A banks open up to HELOC use, where prior to COVID, they were kind of locking down and limiting HELOC or weren't allowing it at all. So on the A side, some lenders may let you use 10% of your down payment from your HELOC, but not all of it. Some may not allow you to use it at all. On the alternate side or the B side, the majority of the lenders do allow you to use at least 10% of your down payment from the HELOC. But we do have some lenders who consider the HELOCs to be own funds. So they do allow you to use your entire HELOC to be able to pay your down payment on real estate transactions. So a bit of a different use case scenario for both the refinance and for the HELOC.
Yeah. If you're looking at crunching numbers too in regards to just overall cost, it always makes sense to be able to do a refinance and use the funds instead of a home equity line of credit, just because that credit facility is much cheaper than what your home equity line of credit would be, or even an unsecured line of credit, for example. I
was going to say, jumping off what Josh had said earlier there in terms of how the banks take a look at your assets and your liabilities. If you do have a really large line of credit, secured or unsecured, and it's typically over 50,000, banks do have the right to do two things. One, banks can qualify you at the entire limit and not necessarily the balance. So on lines of credits, like Josh had mentioned, banks will take a look at your outstanding balance and qualify you at either 1.5% or 3%, depending on how much is outstanding. On lines of credits that are over $50,000, the bank will look at the entire limit and qualify you based off of that. So, especially for like GTA guys and people who are living a little bit closer to GTA Guelph and whatnot, for those of you who have really large lines of credits, especially HELOCs, if you go to apply for a transaction, and even though that HELOC is empty, if you have a $75,000 line of credit, they're going to be qualifying you off, assuming that whole $75,000 is used up, even though it's not. So that can drastically affect your ability to afford a property and debt service the property moving forward. So something to consider as well too, depending on how big that line of credit would be. Yep. And then some other lenders may ask you to close the entire account as well. So if it is over 50,000, same thing. The other option is some lenders may ask you to close it. This may seem silly, but in the eyes of a bank, they see that line of credit as, you could go out tomorrow, close your property, and then use that entire line of credit. And there is no qualification for it. You have the full access to it. So
risk mitigation.
Exactly. Yeah. They see it as a potential risk, and they may ask you to close if it's large enough. So some things to consider moving forward if you're looking to invest long-term and continuously build your portfolio. Some issues you could run into with the HELOC.
Yeah. So, I mean, the majority of the clients that we usually see are pulling money from the refinance other than lines of credit. People usually have lines of credit when they're getting set up with their investment journey, but people who are a little bit further ahead, they're using the refinance for a handful of reasons. One, you can use all of the funds for a down payment on another property. It's very easy to track. You can just get a trust ledger from your lawyer. And it's a non-taxable funds. I mean, obviously a home equity line of credit is also non-taxable funds, but when you pull cash out, there isn't any tax or income that you have to claim on it because it's technically a loan. So you can start using those funds to be able to kind of scale your portfolio and get ahead. Refinancing, on the home equity line of credit side, it is difficult to. There's basically only one option, and you have to be a premium client to be able to do it. It's a very premium product, so you have to have a certain credit score. You have to be able to qualify with your own personal debt obligations. Whereas a refinance, there are a handful of different types of lenders out there who can facilitate the transaction, and they're a little bit more flexible with their specific guidelines and fees. So there are different ways to be able to access and tap into that equity without having to necessarily go through the process of a home equity line of credit or just being like a super AAA client making well over $100,000 a year. We just got a question from Josh Norris on YouTube. Will credit card limits have the same effect as high limit HELOCs when trying to qualify? No, they won't ask you to close your credit cards. They usually just ask for the lines of credit. That is a great question, though. I have never seen it happen. So
yeah, no.
Usually credit cards are standalone entities. They're more or less worried about. If you have a black card, maybe, but at that point, I'm going to assume that you're just so well off that it's probably okay. I don't think I've ever seen any bank ask to close
I've never heard of someone asking to close a credit card.
No. So moving on, there's a handful of things that we see through the investor side of things that are really indicative to the home equity lines of credit and just using equity in general as a tool. A lot of people are trying to figure out that OPM or that other people's money situation, but they don't really look at the cost benefit associated with just tapping into what you currently have. I highly recommend taking that assessment before taking on expensive private money. We have another question here. Are there ways to avoid penalties when refinancing a fixed closed mortgage? That is a great question. In short, no. There is not. So what you're going to want to do is preemptively have a conversation with your mortgage broker about your plans. The average person breaks a mortgage every 3.5 years. Most people walk in for 5-year term. Most people are like, oh, I'm not going to break. And then 3.5 years later, they break the term and they end up paying that fee. And the banks are banking on it. They're hoping that you break it, right? So I would recommend taking a variable rate if you're looking to tap into that equity a little bit sooner than maybe if you initially planned on a 5-year term. That's going to be super important. Other than that, if you're locked in, it quite literally means you're locked in. It's a closed mortgage, and you have to pay the penalties that are outlined in your commitment.
Key number 2, prior to even getting that first mortgage is, and one of the things that we always talk about is just having that goal setting with your mortgage broker up front. If you are going to potentially be refinancing in 3 years, or if your goal 5 years from now requires you to pull out a refinance in 3 years, it doesn't make sense to go with a 5-year term. You're better off going with a 2 or a 3-year term and just being able to refinance on, renewal. When you refinance on renewal, you don't have to break your mortgage. There is no exit penalty. So that's kind of the importance of sitting down with your mortgage agent ahead of time, talking about what your goals are in the next 3 to 5 years. Like I said, if you're going to be, you have a goal that's going to require you to have some sort of equity takeout, make sure that term matches your goals so that you're not in a 5-year when you need money in 2 years, or not in a 3-year or a 5-year when you need money in 1 or 2 years. Make sure you time the term and the, and your goals accordingly, because that can be a big factor as well too.
Yeah, Liam actually has a question on YouTube: is what is a 5-year fixed rate? So I'm going to assume you mean what is the actual 5-year fixed rate, or like what is the actual rate? So a 5-year fixed rate mortgage specifically is a mortgage that is locked in for 5 years at a fixed rate. So if your mortgage broker, you come to your mortgage broker and your mortgage broker is offering you currently 1.69% on a insured mortgage product, most people will take a 5-year term specifically because it is the cheapest rate on the market. The banks will offer a 5-year term because they can basically guarantee what their return is going to be over a certain period of time. And they've realized that 5 years is probably the maximum length people are willing to go to be able to lock into a rate. And people like the ability to be able to change within a certain amount of time and basically put their finger on the pulse of the market to see where their rate's going to be. So basically, you're just locked into that rate for a certain period of time. You will have prepayment privileges and penalties to break if you did break that mortgage. What percentages of mortgages get refinanced within 5 years? That is a good question.
98.
Yeah, I'd say probably like 98%. The majority of people break their mortgages before the term of their mortgage. A lot of people, unfortunately, I would say unfortunately. So a fixed rate mortgage is a phenomenal way to be able to plan out your finances. Most people don't like the change in their finances, and they like to be able to plan things out. A fixed rate mortgage has a little bit of a premium compared to a variable rate mortgage. And most people will take that premium on the basis of knowing that their mortgage is going to be consistent throughout the term of their mortgage. A variable rate mortgage is usually lower, although has the risk of going up depending on what the market's doing at the time. So they both have their advantages and disadvantages. It's just dependent on how you want to plan out your finances.
I think one thing to talk about too on the variable rate is the whole purpose of a variable rate is to maintain it throughout the whole term. You save your money on the variable rates when you on the dips. It's going to fluctuate throughout your term. The whole purpose of the variable rate is to, hopefully have more dips than you do rises and make your money and your savings on the dips. if you aren't one who's, who doesn't have the risk tolerance to be able to see a rising and changing mortgage payment every month, the variable rate may not be best for you. The last thing you really want to do on a variable rate is go out there, get a 5-year term, and then on the first year, you see your mortgage payments change enough and you kind of freak out, and then you lock it in. That you kind of negate the whole purpose of being in the variable. You essentially might as well have just gone with a fixed rate from the beginning. So the tolerance of your mortgage payments changing is really going to determine whether or not you want to go with the variable rate or the fixed. Another thing too is, if you're really focused on monthly cash flow and you're someone who likes numbers to be consistent, a variable rate mortgage may not be great for you because it does have the ability to change, and it could potentially change your monthly cash flow. A fixed rate payment, you at least know, will be the same across the board. So if you're very number focused and you are specifically focusing on a very consistent monthly cash flow, the fixed rate again might be a great option for you.
Hey, Alex, I know we saw that you had a few questions there. I'm going to start with your first one and then hit your second one right after. I hope things are well. Let's talk about an example of a private mortgage really quick, or a private lender. A private mortgage is going to be an interest-only payment. Usually, we recommend these to investors or people who use private money as a tool to be able to force appreciate an asset or be able to scale their portfolio. We always recommend that you take the time to be able to figure out if this product is right for you, because it might not be the best option for you at the time. Now, a private mortgage is usually from either an institutional person or just a mom and pop who has a bunch of money to put in the market. Usually you'll see the rate changes depending on the loan to value. So what's going to happen is, if you are the first position mortgage, will usually go from about 0 to about 75 or 80%. That is usually the risk tolerance for the first position mortgage. You're looking at around, depending on the loan to value, between 6 to 10% in first position. Second position money can go from about 80% to about 95%, depending on the lender. And those start between 10 and 14 to 15%. Each payment is interest only, meaning you only pay interest every single month and none of it goes towards the liability. There are specific circumstances in which it can work for you and it doesn't work for you. We usually find that people who are doing quick flips or are trying to get into a depreciated or undervalued property, it helps them get in, because most banks won't allow them to get into the property because of either there is no tenants, there's vacancy, the condition of the property isn't where it needs to be. So this specific tool is used for that. It's really important to have an exit strategy. Some people use it for debt consolidation. It makes sense financially to be able to do that, but the exit strategy on something like that is, you have to have that dialed in, or else you don't want to stay in a 10% interest only mortgage, because that can be extremely difficult to exit. Alex had another question.
Yeah, in terms of whether it's harder to qualify for variable versus fixed, I don't think there's really any difference between qualifying for either. I mean, it really comes down to the fact that on an A-side mortgage, you're qualifying at the Bank of Canada rate either way. So it depends on what the contract rates are. So if one of the contract rates, I guess I should go back and start on how we kind of look at qualification. So there's two things we look at. We either are qualifying at the Bank of Canada rate, which is 4.79 right now, or we're qualifying at 2% greater than the contract rate. So if 2% plus your contract rate is greater than 4.79, we're going to be qualifying at that instead. So if one of those rates were at a certain point where the 2% above contract was higher than the Bank of Canada rate, that could potentially make it more difficult to qualify for than qualifying at the Bank of Canada rate. But if both of those rates, the contract rates for both the variable and for the fixed, if you took those contract rates, added 2%, if they were both below the 4.79, you're going to be qualifying at 4.79 regardless. So it doesn't actually change your ability to qualify.
Yeah, we have another question here from hey guys. We'll get back to you with all the comments. Thanks for joining our live stream, guys. We appreciate all the wonderful things. Question from Niraj. How about buying a multifamily via private lender money and then refinancing the property. We have a significant amount of clients who specifically use this strategy to be able to get into multifamily properties that are undervalued. As many of you either know or don't know, the value of multifamily properties specifically comes from the net operating income of the property. Now, if you are able to purchase a property because it's either under rented or it's in a state of disrepair, most banks will not lend to you because the NOI just doesn't fit where they need it to fit. If you can get into it privately and you can do the renovations required and be able to turn rent and raise the NOI of the property, you then force appreciate the asset. And once you have a certain ratio of usually 1 to 1.25 DSCR, which is your debt service coverage ratio, so for every dollar it costs you, the property's making 20 cents. Most financial institutions on the commercial side will allow you to refinance out. So, a lot of people who are getting into that multifamily space are looking at getting into it privately. Now, there are some upfront costs and carrying costs to get into it, but the ability to be able to take on the massive appreciation of an asset that valuable, and the opportunity cost of being able to flip the tenants and raise the rent is extremely lucrative. And most people are starting to realize that they're using private money to be able to get into those opportunities.
Yeah, we actually have some really great videos coming out in the next couple of months regarding private, getting into a commercial or multifamily building using private or versus the turnkey option. So keep an eye out for that. But yeah, as Josh said, it really depends. Like using a private mortgage is essentially like it's a solution of pay to play. If you can't get into a building on an A side for a specific reason, whether that's maybe we don't have the amount of time at a job to be able to qualify properly, or maybe you don't have the amount of down payment needed, but you have some collateral equity to get in and you can afford to refinance, or you're looking at a commercial building that is very dependent on its net operating income and there's some vacancies in there. You need another way to get in other than getting into an A lender. Paying to get in through the private side gets you into the building, and then we can refinance out in most of those situations. So private mortgages are really just a solution when the A and B banks are obviously no longer available. And then being able to refinance out is definitely the key idea and exit strategy for all those.
Katharina had a question for us. Said, hey guys, do you have private funds to help for down payment? Let's say $30,000 for 6 months. We have access to that in our line of credit, but don't want to take that before the mortgage finalizes because it'll reduce our TDS. Having private funds, if you had additional collateral, you could do like a small second mortgage to be able to take out the funds. Now, that being said, if you did a private mortgage, you'd be required to be able to reflect that on your application. And if it reflected on your application, it would obviously affect your TDS anyways. Borrowing, yeah. It's like kind of the same thing at the end of the day.
The product that you're talking about specifically, I think, is more of an unsecured product. So we do get this question a lot, actually. We have a lot of investors who reach out and ask if we have small amounts of private capital available for lending. Somewhere between like that $10,000 to $40,000. So one thing to remember with us is we are equity-based market. So our private guys lend on equity. So any time that you're going to put a private mortgage on a property to be able to access that equity, we do have to technically qualify with that. So if you have a private second on your property, we're going to have to use those parameters to help qualify. So, that could essentially help reduce your TDS and your ability to afford the new property anyways. In unsecured funds, like this was for what? For down payments, or what was this
for? Down payment, yeah.
Yeah. Unsecured lending and borrowed funds, unless you were getting it on a private mortgage anyways, you wouldn't really be able to use because it would have to either come from yourself or gifted from immediate family member. A refinance would work, but if you were taking a look at, a refinance versus a line of credit, we would essentially just have to take a look at which had the greater effect on your debt servicing and which made more sense. So it just comes down to the numbers essentially on that question.
We have Jacob in the chat here. Jacob, we appreciate all the kind words. Jacob was a client who we were able to help get into a 5-plex and a duplex. Jacob is in his early 20s and is an absolute rock star and is moving forward with his investment journey. We're able to use some flexible financing solutions to get him to where he's got to go. And we're excited to see where he's going to be going in the future.
Yeah.
Josh Norris had a question: Scotia Step or Manulife One? Which is better for an investment property, and which one do you like better? So those are two similar products, but different products in the same. So Step product has a home equity line of credit attached to it. It's a lot like the Fusion product. It's a good product if you want to just have one product in it. The Manulife One product is a little bit more premium. It has the ability to be able to have multiple loans inside of it. So the way it works is it's almost like a single bank account, and then that bank account, all your money goes towards the debt that you have, and it pays it down every day. They figure out your interest rate and they calculate it daily, and then they add it all up, and then at the end of the month, that's your interest rate. So you only pay interest on the amount of debt that you carry. So it's almost like a giant checking account where your money goes in and your money goes in, and and paying down the debt that you have on your property. It's a great product because you can break up little loans at different interest rates inside the product. You have to have the ability to be able to have some sort of self-control with this product because you have unlimited access to the equity in your property. Whereas the Scotia Step program, you still have to pay down your mortgage. You don't have access to that equity. So, they're both really good products. I would personally, if I had to choose a product, I would definitely probably choose the Manulife One product just because it gives you a little bit more flexibility. And I like the fact that you can pay down the debt that you have as fast as possible.
Yeah, it makes sense if you're considering the Manulife One product. It makes sense to use that as the bank account that your paychecks are getting deposited into as well. Because as Josh said, it's just a revolving balance. So of all your debts versus the amount of cash equity that you have in that account. So the more money that you're putting into that account, the more you're paying down those debts and then are able to draw upon that equity. The Manulife One product, it's a checking account, but it essentially acts as a line of credit. Whereas, like Josh said, all your total debt accumulates into there. And as you put your income or payments in, it just pays it down as you go. So Josh touched on it, but yeah, it's extremely important that you're diligent with your finances. If you're not on par or not where you'd like to be currently with your finances, I'd maybe wait on the Manulife and go with another product, but the Manulife One product can be a great product to have.
Yeah, we had another question from one of our members in the chat. What would you recommend to someone with low income but has a significant equity in their personal residence? That is a great question. I had actually a conversation with somebody today who has well over $1 million in equity in the property, although can't show any income. Unfortunately, most conventional lenders will require that you can show income to be able to qualify. Most people who have significant amounts of equity in their home don't realize that you might have the equity, but there isn't a lender out there who's going to lend you any money against that asset if you can't show that you can make those payments. Conventionally, we need to prove your income to be able to qualify. If you need access to the equity in your home and you can't qualify conventionally, there are private either institutions or mom and pop lenders who will lend on it. If you have a significant amount of equity, like under 50%, you can get very cheap private money. There's obviously a cost to get that private money, but there are ways in which you can use the equity in your home as well without having to pay fees. So if you're looking to purchase a property and you want to cross-collateralize and use the equity in the property, there are lenders out there that might be able to do 100% financing to help you get into the property without having a ton of money out of your pocket. So there are different ways to be able to use the equity. It's just a matter of, what financial situation are you in? What's your credit score? What do you qualify for? And then how does that work? We have another question here from Liam. I think in that situation, you take your equity and purchase investment properties to get cash flow.
It's a good option, but the main thing that we have to consider on traditional financing is that regardless of what type of assets and liquid net worth you may have, it's all about qualifying at a debt service ratio. So if you can't debt service any of the payments, that's really the limiting factor. There are lots of great options out there. So if you do have provable income, either 2 years, or there are some B lenders out there that do have 12 to 18 month type bank statement programs. On the B side, we are able to use a few different things. They have larger debt ratios that you can go into. There's some lenders out there that have 35-year amortizations, which reduces your monthly debt obligation of your mortgage payments. If you're looking to purchase a rental property, they can have a much more aggressive offsetting of the rental income, which can help to lower your monthly debt ratios as well too. You could buy the house in cash, but there's a few things that you'd have to do. You'd have to be able to refinance and qualify for the refinance to be able to pull out that equity. If you don't have the debt servicing to pull out that equity, you'd be stuck. And then again, in terms of having a line of credit, if there wasn't any line of credit on there already, you'd have to qualify for the line of credit. And then again, you're limited in some cases with how much of that line of credit you can use to be able to put down on the down payment. So it is an option, but again, it depends on what the current situation is for that borrower.
Yeah. I think it's, if you don't have the qualification, purchasing cash loan property obviously makes the most sense. If you have income, but it's just not enough to get to where you want to go, taking a look at larger multifamily properties, if you have equity, like it makes sense to look at it at that specific type of real estate. People kind of don't understand the fact that the building qualifies by itself. Like, I mean, obviously you need to be competent, you need to have a decent credit score, you need to have some sort of income coming in, maybe some cash reserves in the bank. But, if you have a low income and you don't qualify conventionally for what you're looking for, start looking at fiveplexes, start looking at lower value sixplexes, something that has cash flow and you can get it done either privately, get into it, do some renovations, and then refinance it into like a credit union or traditional lender. That cash flow is going to be king to you, and you don't have to qualify based off your own personal debt servicing, which is super important. They take a handful of things into consideration. So, I would recommend, if you're in a situation like that with a bunch of equity, low income, take a look into maybe a little bit of larger multifamilies that aren't super high price. So just Windsor, Sarnia. Yeah.
Another question here from Ali. Amazing video, guys. Thank you very much. Random question. Advice on an individual with 800 credit score with cash in hand, but no employment in the past year due to COVID. Should I even bother trying to qualify for a mortgage? So a couple things come to mind here. In terms of qualifying right now, currently, if you're unemployed, you would not qualify for traditional A or B financing. One option you could look at is getting into a private mortgage. You have the cash to be able to put the down payment down, but your exit strategy would be coming up with a job that is guaranteed hours. So as long as you can get into a job in the next year or the year within your term of the private mortgage, and you have either a salary or guaranteed income and you're off probation by the time you need to refinance, that would work. But again, that whole exit strategy is dependent on you getting some sort of guaranteed income before refinancing. So solutions, again, the exit strategy is very important.
Yeah. If you are in a situation where COVID has affected your income and you're looking for additional employment, the easiest way for you to get into a property is going to be getting a salary job. So if you're getting an hourly job and you haven't been in that specific type of employment for 2 years, we have to have 2 years history, and that 2 years history needs to be inclining so we can find the average of it. It's going to be much faster for you guys to just go get a salary job somewhere. And then from there, you're able to use your income right then to start qualifying for a loan.
Mm-hmm. Guaranteed minimum hours work as well, too. It's essentially salary, but there are some jobs. As long as the job letter states that you work a bare minimum amount of hours or you are on salary, we can use that without a 2-year history.
For sure. So some kind of thing that I didn't know that everybody else didn't know, I wanted to share with you guys as well, is no lend zones. So if anybody is looking to purchase property in Hamilton, most conventional and B lenders have a specific area in Hamilton right near the water that is a no lend zone. So if you are looking to purchase property, I would highly recommend reaching out to a broker or have them reach out to a BDM to test the waters and just see if you can qualify or if you can get 80% loan to value on that property before you go firm on it, because there are specific areas that lenders will not lend in, specifically because they're worried about contaminants in the soil.
Mm-hmm. Is this a new question or the same question?
Same questions. I'd appreciate it.
Oh, no, this one up here.
Oh, perfect. I think there's Jacob.
Oh,
yeah.
Awesome. I'm trying to think. What else?
What are you thinking?
We just want to say we appreciate all the support that we've had on the 20,000 down product, that flip product. We've had a lot of people reach out. A lot of people be pre-approved too. We've actually had a lot of people already get pre-approved and have already started moving on properties. And we released that product 2 weeks ago. So super quick turnaround times. Even if you guys aren't immediately considering a property, we can still get you guys pre-approved with that lender. So that just makes your turnaround time much quicker. It can definitely give you guys a little more confidence if you're considering purchasing a property and going in without any conditions. I mean, we don't ever recommend going in without conditions, but if that's what you're looking for, having pre-approved and knowing that you're good to go in a certain price point with a certain ARV, that's, that can definitely sometimes be the difference between getting in and not getting into the property. So make sure you guys just reach out and let us know. Good question, Alex. The pre-approval for this specific product is good for 1 year. They qualify people once per annum. So if you get qualified at January, you don't need to be approved for the rest of the year. They just have you on file. They know that your details are good, and they just move right into approval or not approval on the deal, depending on the amount of profit in the analyzer spreadsheet. So these guys just do it once per year. Other than that, once you've been pre-approved, you just bring them the product. We show them the spreadsheet. We make sure the values are there, and they're good to find, next day or in the next couple of days. So
for sure. We actually just got a question again. Can we rewatch the 20K down video? We actually just reshot a video with Matt yesterday. We're going to try to launch it ASAP, just so everybody can rewatch the video. Unfortunately, the video that we had was not that great. I believe if you go onto our Instagram channel and you go to the stories on the right hand side there, you should be able to watch the video, or at least part of the video. Other than that, guys, we really appreciate everybody tuning in. If you haven't already, please hit like or subscribe. We obviously want to create content for you guys, and the more content that we get, the more audience that we have to be able to share information with the world, guys. We're going to be ramping it up quite a bit this year and next year, and we're looking forward to doing so with our media team as well. We are doing a giveaway. We're going to be launching it next week, so stay tuned for that. If you guys want some really cool free prizes, let us know, and you'll see a post shortly. If you guys have any questions, again, reach out to Aaron or myself. We'd be happy to answer them at any time.
Enjoy the weekend, guys.
Take care, guys.